Chris, thank you very much for joining us today. With everything happening in the world and the volatility picking up in the markets, I thought we should spend a few minutes together and get your views on what do you think of the price action in the past week and where you think markets might be going in the coming week. And before we do that, I want to remind all of our viewers of your services. If you like Chris and you want to learn more about his services, we have a link below in the show notes. Check it out. And with that, Chris, why don't we just start looking at the indices? The S&P peaked out on July the 16th. It's currently down 5%. The NASDAQ topped out on July the 10th. It's down about 10% from its highs. The volatility index also spiked, got up to a high of 30, and it closed around 23 yesterday. But why don't we just start by looking at the S&P and see where your levels are?
Yeah, sure, James. Well, thanks for having me on the show again. And yeah, let's take a look at the charts. So if we look at the SP 500, what's been going on, you can see definitely we've got a leg down and it has a pretty bearish price action. This is known as a bear flag pattern on the SP 500. So you have a flagpole to the downside. The price action is flagging in the opposite direction of the down pole, and it points to lower pricing. And simple analysis, we can use Fibonacci extension just to get an idea of the overall downward momentum. It's pretty darn close to reaching this green line. This green line is a 100% measured move. And how Fibonacci works is based on momentum and percentages, and more or less the move to the downside, that momentum, that strength. Once it consolidates, you can measure that same leg to the downside from here. So there is still some downside in the SP 500. Potentially another percent or so. The NASDAQ, a couple of percent, I think 4 or 5% actually for the NASDAQ. But the chart pattern is definitely bearish. We're seeing, if we were to look at the SPY ETF here, we can see on our short-term kind of momentum chart, we've got the market changing trends on a short-term standpoint. So we saw this about a week and a half ago. The market trend changed. We exited the SP 500, the NASDAQ, and since then we're going down. And so we're seeing a lot of the technicals, James, break down. We're seeing money flows moving into utilities. We're seeing gold hitting new all-time highs. Along with panic selling on the VIX, the volatility index is skyrocketing. So there's a lot of fear. And we just started on Friday. We just finally saw the put call ratio go above 1, which means the majority of people are buying put options. So not only are they scared and they've jumped out of their positions, now everybody's starting to add leverage and betting on falling pricing. And as I just showed you, there's like potentially only 1% to the downside on the SP 500, maybe next week. I think it's ready for a bounce. I don't think we're going to start a new rally in the stock market, but is ready for a bounce. And that bounce will probably shake out short-term traders who buy puts and then see them quickly drop in value as we get an oversold bounce next week. But let's take a look at the NASDAQ real quick. The NQ.
Oh, Chris, before you go on to the NASDAQ, I want to ask you about the spiders, okay?
Yep.
So when I look at this, where did the spiders close? Is that 532?
532, yep.
And so where do you see downside in the coming week?
The downside in the coming week, I would say, let's just grab that level. It's about 1% to the downside from here. So roughly 527. I would think it's going to probably try and find some support through there. We're definitely starting to see, obviously, the big volume spikes here. We've got lots of negative volume selling. So people are dumping shares. Everyone's running from the market. And typically when everybody's doing that, coupled with fear index, coupled with measured moves with Fibonacci, I just showed you, and people starting to buy put options, people are now convinced the market's going down. And generally, like, I think we'll see the market come down and then it might have a nice bounce and really just form another one of these waves where it sells off, it rallies up and continues to pick up speed and could have a very big drop over the next, couple of months, really.
Okay. And when it bounces off of that 527 or 528 level, how high do you see it going?
Yeah, I'm not sure. It's probably somewhere right up kind of where I drew. Probably if we just were to highlight this technical level, there's a lot of volume through here. And obviously this is where this other bear flag core body was. So it'll probably naturally come back up to this level. And that's simply because there's a lot of people who bought through here and then they experienced gains and then they came down here and they're like, I'm at break even. It should bottom here. And then it breaks down and they get the crap scared out of them. And then finally it comes back to break even. And those people, all of these people who bought through here will be like, okay, just get me out. I'm scared. And so as it runs up here, we're going to have a bunch of volume selling here
So
that'll
if
stall it out and move lower. So that's the 545 area, I would say, somewhere in there.
okay, so if we do get a lift this week, you think it's an opportunity to sell your longs or to get short?
At this point, yeah. Yeah. You don't want to be long the market. When we look at the SP 500, our signal charts here, it's pretty clear. We've got red bars. When it's red bars, you don't want to own the market because it can fall out of bed and you never know how far it's going to go. And right now the trend analysis is weak. And we can see last time, even though we got red bars, it did move higher and we had a new signal. But in a lot of cases, this will flatline for months or it'll sell off in a big way. And you're best to wait for a new trigger. So the bounce that we get next week will most likely get sold into, and we're probably going to start to see a very big sell-off. Like obviously we've had a massive rally since last November, and a lot of that I think is going to unwind probably down to the 490, 480 or so level, potentially over the next couple of months.
Okay, so let's take a look at the NASDAQ.
Yeah, NASDAQ obviously in much more pain. It's sold off. It actually has quite a bit more downside potential using Fibonacci extension based on the moves. And you can see it actually still can go into a pretty big free fall mode. Percentage wise, the NASDAQ could still fall about 5 to 6% to the downside, which is on the NQ, that's about $17,428. So that's still a big haircut. That means we'll probably see more unwinding in Nvidia and all the Magnificent Seven stocks. And the SP 500 won't quite have as much downside simply because it doesn't have quite as much weighting as technology. But the tech space here is definitely going to, I think, accelerate. And there's still quite a bit of downside left before it gets oversold and hits this target for a bounce.
And why don't we take a look at the volatility index?
Yeah, when we look at the VIX, I mean, it was up 25% yesterday. If we just kind of, let me full screen it a bit here. More or less, if we take a look at it and zoom out on the charts, you can see we've got a high level of fear. So people are really starting to panic. They're dumping shares. And the saying goes, when the VIX is high, it's time to buy, meaning everybody's dumping shares. But the VIX, the way it works is the VIX could start to fade here and top out. Potentially Friday was the high. The VIX can start to move down a little bit, but the stock market will still fall. There is a delay in fear and how it works. So just because it's high right now doesn't mean it's the bottom. Again, I still think there's a percent and change down on the SP 500, 6% on the NASDAQ. So I don't think the VIX is going to skyrocket a whole lot higher from here. But I do think the stock market is still going to grind its way lower for a few more days as it tries to hit those Fibonacci targets. And then we'll have a bounce. And then the VIX will probably drop back down into the 18, 16 area going forward.
And so, as we mentioned at the onset, there's been a big rotation out of the big cap techs into a number of other names. Gold's caught a nice bid. The utilities have caught a very nice bid, and also the Russell. Why don't we look at the Russell 2000?
Yeah, the Russell, and this is where this, as you're kind of saying at the beginning, like what's been going on in the past week and what's been really going on in the last couple of weeks is the markets have gone really haywire. And if I I'll go to the weekly chart here real quick of the Russell 2000. And what's interesting in how people move into aggressive growth stocks and stuff is we actually saw back in 2021, we saw the stock market top out. Most growth stocks actually topped out in February, March of 2021, like the ARK ETFs, and they sold off. And I mean, they just got annihilated. The Russell 2000 held up fairly well. And then suddenly everybody, for some reason, wanted to move into small caps. And they pushed in thinking it was going to be the next big rally. And then we sold off into the 2022 bear market, where the market pulled back very substantially. Well, we've seen something very similar to that now. We've seen the Russell 2000 hold its ground while the stock market's been topping out and pulling lower. And then suddenly the stock market starts to fall in general, the large techs, and we saw a huge pop back into Russell. People were getting very aggressive again. It actually took 2.5 weeks of selling in the indexes, like the SP 500 and the NASDAQ, to even get 1 day of the put call ratio above 1. So people are still actually not afraid. They're not buying put options. They're moving into small cap stocks. And so the last time we saw this, the market pulled back like 25%. If we go back to 2008 and take a look at, whoops, let me just get rid of that. We go back to 2008, we saw the same thing happen just before the big sell-off. If we zoom in, we see the Russell 2000. It consolidates, and then suddenly you get a big pop. Everyone wants to move into small caps, and then it goes into a huge sell-off. So we're in this phase where the markets are giving a lot of mixed signals. Right now, we're sitting in cash because we don't know which way the market fully wants to go, but the signs are there. The internals are breaking down. Money's flowing out of stocks in general, moving into defensive sectors and commodities. And the Russell 2000, along with more or less, if we were to look at the whole broad market, the way I like to look at the broad market is actually you add the Russell 2000, the IWC, which is the microcap or small microcap stocks, and the equal weighted SP 500. And if we look at this, James, from this market condition that we have, this pattern, I see a huge stage 3 topping phase, which you and I have talked about many times, which is the market breaks down. It goes into this complacency move where people think this is the start of a new bull market, but it's actually the market's about to go off a cliff and start a huge bear market. And the visual of that, Stan Weinstein, I follow his strategy, is based on these 4 stages. And we stage 3 topping phase. That chart I just showed you got rid of the Magnificent Seven, more or less, or at least toned down their weighting. And it shows you the thousands of small cap stocks, the thousands of micro cap stocks, and the equal weighted SP 500, which gives us that stage 3 topping phase right here. So the underlying technicals are breaking down from a long-term standpoint. The charts are pointing to the end is super near, and things are probably going to get pretty ugly in general. Doesn't mean it's going to happen right now, but it means we could, over the next several months, I think we're going to see the market stall out and eventually start to put in some more bearish price action, and start a journey that could be a 1 or 2 year kind of sell-off, depending on how it unfolds.
So before we move on to some of these defensive names that have been working well in the past week, I want to go through some of these tech names, and I want to start with Nvidia, just because it's the poster child for the risk on trade. It topped out in June at $140. Now it's at about 107, so it's down 23% from its top. But where do you see this one going?
Yeah, so Nvidia definitely has it had some pretty good price action over the past few days in terms of price swings. We saw this washout low take place. Same pattern that happened over here. We saw a rally up, it paused, and then came up for a double top, and then we saw washout panic with huge selling. I was showing subscribers this last week after the market closed. They said we had the same type of price action. And then we had washout selling in the market. We saw it in the market, and I said, expect Nvidia to bounce. It doesn't mean it's a rally. It just means we're going to have a sharp bounce. It bounced 12.5% the very next day, and it went right into resistance, which is this breakdown level of all these kind of pivot lows. And then it reversed and sold off. So it has it kind of has some mixed signals. The whole market has mixed signals. So everything's a little wishy-washy right now. I don't have any like solid, like do this right now. It's like stand back. Let's let the dust settle. Let's get a feel for things. Nvidia's got the price action where it has these big lower wicks that sell off, huge sell-offs and pops and drops. That's the sign of just volatility, indecision. Usually it means that we're kind of at a short-term low. So we could still see this market bounce. Like next week, I think we see stocks sell off a little bit, but then have a bounce. And I think depending on how the bounce unfolds, if we see the Nvidia start to form what could be a bear flag pattern, which is a leg down, the other leg down will come in a week or 2 or 3, however it unfolds. So I do think Nvidia's long-term, it's still in an uptrend, but it definitely has the volatility that it's getting exhausted. And the last time it did this pattern, it did rally fairly significantly. So it's broken below all of its key moving averages, the 20-day, the 50-day, the 5-day. They are sloping down. To me, it's just steer clear of it right now and just see if it is actually starting a new downtrend, like if it has another leg down, or if it is actually going to build a base, a pause, and then start to break out and start to move higher, potentially above this 120 mark will be a fairly, I think, bullish sign for Nvidia if it can hold up above there. So.
But if you're looking for a pullback in the general or in the broader indices, there's no way Nvidia is going to rally.
No, it'll probably struggle. I mean, yeah, it'll probably struggle. Pretty much all stocks almost move together. So I do think Nvidia could still struggle and trade sideways and potentially move a little bit lower. This is just going to be a big volatility range. Just expect pops and drops. It's very random, right? So it's an area you would generally just want to steer clear. For some reason, everybody gets like we get this huge movement and volatility in the indexes and all that stuff. And everybody seems to want to get in and try and catch these moves. Like people are like, why didn't we catch a 12.5 move in Nvidia? I'm like, well, I mean, if you think you're going to catch those 1 day reversals that are given back the very next day, I'm like, you have this false belief of what's available in the market. I mean, short-term strategies, we saw it somewhat coming, but just because there's a lot of price swings doesn't mean you should be in there poking around trying to pull money out. In fact, I do the exact opposite. We got chaos, uncertainty, mixed signals across the board. We just step aside, let everybody else lose their shirts and gamble and swing for the fences. So again, I don't have any clear momentum here, any clear signals on Nvidia. It's really just a crapshoot at this point, and we just need to let it chop around for probably a week or so and see what patterns it shows us, what the volume's telling us, and then we can kind of reassess.
So I want to take a look at Apple now because it had a pretty good week, and it was just announced that Warren Buffett sold down half of his position. So when that news hits the market on Monday, it'll probably come under some pressure. But what do you think of the Apple chart?
Yeah, when we look at Apple, I mean, it's in a very strong uptrend still. It's just had a controlled pullback. It does have a little bit of a bearish pattern. Like we obviously have this pullback and it's kind of consolidating, which does point to potentially another significant leg to the downside. Now, a technical trader will look at this as a shoulder. This is a head and this is a shoulder, and there's a rising neckline. If it breaks this sloped neckline, the distance from the top to the neckline is usually the downside target, which if I just grab that, you can see where that could be, which generally falls in line with the Fibonacci analysis as well. So Apple could very easily fall and zip down to 200, which is a whole number. It's also a level where it broke out from back over here. It was also a previous high. So if we start to see it break down below 218, 217, 16 area, it could have a precipitous fall back to 200. And 200, not only is it a breakout level, it's a whole number. And generally, investors will say, if it falls to 200, which is a nice whole number, they're like, I'm going to buy some Apple shares. So if you're above a whole number, when it settles down to that level, there's going to be a bunch of orders there with people saying, I'm going to buy some shares at 200. When you're underneath it, which is what happened back over here, it becomes a resistance area. People are like, well, if it gets to 200, I'm going to sell my shares because that's an upside target. But if it breaks it, then it's going to blast through it and go the opposite direction. So 200 is a potential downside target. It's the head and shoulders measured move. It's a Fibonacci measured move, roughly. There'll be obviously some volatility, but it is still holding up in an uptrend, but it has a bearish pattern. So if it starts to break down from here, it'll go from a bullish uptrend to it is now in a downtrend.
Well, the fact that Warren Buffett has sold this stock after holding it for many years gives you an indication of what he sees on the horizon. He must be quite concerned. He also sold a big stake in, I believe it was Bank of America last week too. So it will be interesting to see what he does with that cash, if he does anything at all.
Yeah, it'll be interesting to see how everybody reacts to his analysis. I mean, I have an Apple. I don't use an Apple computer, but I have an iPhone. And Apple and Tesla, it's kind of like a cult. People who buy those shares, and as from just on the outside, because I am not like a brand snob or anything like that. We've seen Apple just losing share. They've slowed down. They don't have any. Well, I guess they have some new fancy like other new products like VR and stuff, I think, but they feel like they're losing their pace. And we can see Bank of America, you just mentioned, it's going into a precipitous waterfall. So I'm interested to see how many investors follow suit. If Buffett says he's sold his shares, it'll be interesting to see how many people are like, I'm selling my shares then, right? Because he does have a huge following, but it'll be interesting.
So one other tech name I want to look at before we move on is Amazon. They came out with their numbers. The stock got hit quite hard. And where do you see this one going? Well,
Yeah,
that's
I
a
mean, this is
massive
a
gap on the downside.
yeah, Amazon is kind of another kind of cult. Everybody uses them. You kind of want to own shares of a company that you use. I mean, I have Amazon packages arrive every day. It's like Christmas here, it seems. We got this huge gap to the downside. The thing, when we have these big moves, I think in these big brand names where everybody wants to own it, um, it can be something very similar to like this, where it sells off, it flushes down, and there's going to be a lot of bargain hunters saying, you know, it's just a good buy. I want to buy it, and they'll think it's a discount, and they can buy it right back up very quickly. But I do think I think the momentum has changed. Like if we just take a look at the chart, James, from my Fibonacci standpoint, let's just take a look. I haven't measured this, but it looks like it's pretty accurate. There's the measured move. So if I was to draw that, we have the Fibonacci, the sell-off. We've got this bear flag formation, which is known as the halfway point. Then we have the bounce up to grab our Fibonacci point, and then it comes all the way down to this 166. And of course, there's volatility and news, so it flushed through there, but it is clustering right at that move. So technically, Amazon has hit its downside move. And I think we could see value hunters step in and be like, hey, this is a steal. This company is going to be around forever, and people are going to buy it back up. So I think it's a shock gap, and people are just going to buy it back up because it's actually had its downward momentum. And the markets have been doing this a lot lately, across the board in bonds too, is the market keeps creating these massive gaps or just gaps on the chart that, you know, we want to be able to catch these legs to the downside, but the market makes it so it moves to that spot already. So we can't capture a lot of these. And that to me is telling me there's a lot, very thin liquidity in general. The markets are able to move things around. So us traders can't catch these really clean measured moves. Instead of just gaps and the opportunity's over. And now you got to play a counter trend trade, whereas like you're trying to play a bounce within a downtrend, which has a lower probability. But I think it'll claw its way up because it's already hit its 100% measured move. So I'd expect a bounce at least for a few days at worst.
Okay, so we took a look at a lot of the high risk names and how they're all coming under pressure here. Why don't we take a look at what's working and take a look at gold, okay? Because it's trading at or near all-time highs, $2,500 an ounce. I think it
Yeah.
probably should be close to 3,000, but anyhow, we'll take 2,500. Well, what's your take here on gold?
Yeah, I still really like gold. I think gold's going to 2650, 2750, which is more or less, you know, up to here or somewhere up to here. So there's still some good upside potential percentage wise from where it closed. You know, there's still another 10%, 11% to the upside, which is really just Fibonacci measured move. You have the run up, you got the pullback, and then the second half of that move. So I'm still bullish on gold when we look at it over the next several months. Now, the monthly chart, which you and I looked at last time we spoke, the monthly chart to me is when we step back as a long-term investor, where is gold going to be 5-10 years from now? I believe we're in a new super cycle for gold. It's had a pause, and we're having a run up as we get closer to a recession, to a financial crisis. People are moving into gold, very similar to what we saw over here. We had a new super cycle for gold. It consolidated for a couple of years, and we saw money moving into gold just before we got into a recession and a financial crisis, which was the 2008 pullback. Gold pulled back 32% or 34%, and then it took off. So I believe gold has this little bit of upside back to, you know, 2650, 2750, and then we're probably going to hit this recession, some financial crisis, whatever blows up, and then we're probably going to see gold have some type of pullback. And then after that pullback, which I'm kind of hoping is next year, is when gold starts this next multi-year run up. So short term, I'm bullish on gold. Long term, I don't think there's a huge rush to get in because I think it's going to be back at this pricing or a little bit lower, you know, maybe a year from now. But that will be the last opportunity to like pick up physical or miners. That's when miners should come to life, is somewhere over here after we've had the financial reset. They should come screaming back to life. So depending on who you are, the type of investor you are, like I like physical metals. I've got physical metals. I don't have any gold miners at this point, just because I think gold miners are going to be amazing, you know, 6, 8, 12 months from now. That's when they'll have an opportunity that could last years.
So you're bullish on gold. What about silver?
Yeah, silver is much more volatile. Obviously, silver is nowhere near the highs up around $49. This is the weekly chart. It's nowhere near the highs from just even a few weeks ago. It's actually still down 13%. Silver, I'm bullish on silver. Silver percentage wise, I think is going to do exceptionally well. It'll outperform gold in the long run, but gold is the global safe haven play. It's low volatility. People from everywhere buy it. It's kind of one of their first plays. Like, what do I do if I don't want bonds or stocks? They say, I'll get some gold. More aggressive traders move into silver. They move into miners, and they have more potential, but they're a higher risk. And I took my son to the horse races, or took my family to the horse races on Sunday, and the kids had a blast. And it's funny because my son, they can put on $2 bets, and he always wants to bet for like the 100-to-1 odds, the 50-to-1 odds, so he can make a bunch of money. And the last race we did was the best probability of the night. It was the fastest horse by 2 seconds. Compared to every other horse. There was only 7 horses in the race versus 9, so the odds were better. We put all our money in on it, and then we won, and we only won half of what our bet was. So we put in, $100, we would get $150 back. He was expecting we put a $32 bet in, which was all the change we had left from losing all night, which was his lesson of gambling. Anyway, long story short, if you're not going to make a ton of money, if there's not huge opportunity, it's probably a consistent, high probability trade. Silver and miners are volatile. People get into them and they suffer forever until there's a super cycle, which we're still probably 6, 8, 12 months away from the next major leg up. Whereas gold is hitting new all-time highs, as you mentioned, James, and it's just consistent. If you want a low risk, high probability trade, you're not going to like make a fortune, consistently make money. Gold is that. That's why I love physical gold. I like charting gold, and silver will play catch up later, but you got to go through that roller coaster ride because it's a risky one, and you need the stars to align perfectly for gold and for silver and miners to like skyrocket. And it's a very small window.
So I want to look at a couple of commodities now that are sensitive to the economy, and I want to start with oil, and then I want to look at copper. But tell me, what do you think of this oil chart here? Because it's been vacillating between this $70 to $80 a barrel, and even with all the troubles happening within the Middle East, you think it might catch a bit of a bid, but it hasn't. And I want to get a sense if this is just under pressure because of a slowing global economy.
Yeah, I mean, when you look at crude oil, even going back to 2006, like in reality, it really is, if you just kind of trim the highs and the lows out, it really is just trading in the middle of the range, trying to figure out what to do. In the grand scheme of things, this is the monthly chart. It has had a move down. It's got a pennant formation, which is very similar to a bull flag pattern. It's a halfway point. I believe it's going to go down to about $40 per barrel as the recession kicks in. If we look at the daily chart and kind of zoom in on the closer price action, definitely has some selling. It's breaking down below kind of some pivot lows here. If we were just to connect these lows, I actually think the lows go back even further here. So it is kind of starting to somewhat break down through these levels. We've got elevated volume. I'm bearish on oil. I mean, it might bounce and want to go to the upper end of the range. This pennant formation that you were talking about has been oscillating through this narrow little range. But overall, I mean, the long-term chart of oil it's stuck in the middle of its range, which gives you a 50-50 bet of which way it's going. When we zoom in a little bit, it does have a more of a bearish chart pattern pointing to lower pricing. So everything to me is saying lower oil, it's going to get a huge cut in price down to that $40 range potentially over the next year or so going forward.
Can you go back to that longer term chart?
Yep.
And I'm always amazed that, given the size of the oil market and how large it is and how much volume trades on a daily basis, I'm always amazed at the volatility. And I remember 2020 so well when oil went down to $25 a barrel, right?
Yeah.
And I can't even remember what the catalyst was, but then COVID hit. I think that was that was a big part of it too. And I'm sure there was something going on in the Middle East, but then it found a bottom, right? And they just ripped, and it went from 25 all the way up to $120 a barrel. Like,
I know. And I remember watching the futures chart, and I usually try to capitalize on chaos. I remember like, I think it was like May 2010, there was like the flash crash. And I remember I was washing my car in the driveway. And I remember my partner was on the computer. He's like, "Oh my God, something's happening." He's like pounding on the window. He's like, "Get in here." So we traded futures. We profited from the chaos, the drop. But I remember watching this crude oil drop. I remember watching futures go negative. And I'm like, I'm calling a few people. I'm like, I didn't know they could go negative. How does it work? And I wanted to get involved so bad during the chaos in oil. I just couldn't bite the bullet because I had no idea it was doing something I didn't know it could do. So,
Yeah.
and that's where a lot of people got sucked in and lost a ton of money messing around with it. And that's where like I think self-discipline stick comes in, is if something doesn't make sense, even though you know there's opportunity, you're best just to watch it and be like, I saw it, I experienced it, but I didn't take part of it. But that was the weirdest thing, watching it go negative. That blew my mind.
Okay, so let's move on and look at copper now, because this is another commodity that's very sensitive to what's happening in the global economy, and it's also been coming under pressure. Got up to $5 a pound. Now it's heading down toward $4 a pound. What are your thoughts on this?
Yeah, copper's kind of just been kind of slowly running its way up into the upper levels. Every time it gets up to these upper kind of this upper channel area, it wants to pull back, and it is definitely showing signs of that. It had a huge kind of reversal type of bar. This is the monthly chart, so it ran all the way up and then got slammed back down. That's not a good sign. That means there's a lot of people selling it. They know it's overvalued, so they're dumping it, and it's come right back down. So it's settling down into a little bit of a support area, kind of where this little pennant formation is. But overall, I mean, I think it's going to have a fairly big correction. The last time we had a stage 4 decline, whoops, that was not the tool I was looking for. Last time we had a stage 4 decline, which was 2008, copper fell off a cliff. And I believe that's like kind of what's going to happen again. I'll probably see 250 or $2 copper, I would think, as we go through a recession and everything just goes into a massive sell off, and housing, everything kind of comes to a grinding halt. So I'm bearish on most things. The only thing I'm not really bearish on is gold in the short term. The rest of the markets are like chaos. I think everything's going to be heading lower over the next year or so.
Chris, I want to take a look at TLT now, because this is something that's working quite well. And it's all based on the fact that interest rates are going to be going lower, even though the Fed hasn't actually cut rates yet, but
Mhm.
everybody's expecting them to do so. What do you think of TLT?
Yeah, I'm starting to really like TLT. Obviously, been in a huge bear market ever since rates started to rise, and they've just been a free fall mode. The price action here is really good. I really like this type of price action where you have a bit of a bear flag and it goes into a waterfall sell off with massive volume. It has a very sharp bounce and then it kind of fades back down. This type of formation, the way that this has moved is very emotional. This is the signs that it should be bottoming. This is the monthly chart. So if we look at the daily chart, obviously you can see the big pop we saw with the Fed, and as we inch our way closer to rate cuts, we're getting closer to this trend turning up. Now we don't own bonds. We haven't traded bonds since the day it peaked out. We actually got out at the high at the open during COVID, and we haven't been back into them. But bonds are like potentially a couple weeks away from confirming a new uptrend. And people have been front running that. We can see that just in the volume alone. Really, we've seen elevated volume. People are moving in. I've talked to a lot of advisors. They're all saying, get into bonds, get into bonds. Unfortunately, most of their clients are already in bonds and they've been holding them from, they're down 40% on them. But they're trying to tell people to shuffle in, which is a little bit concerning. But I'm not a fan when everybody's saying get into bonds. But if rates are going down, we should see bonds go up, and they are starting to firm up. And we saw a lot of panic on Friday in the stock market with the VIX skyrocketing, stocks crashing, and we saw people move into bonds. As I think what also helped fuel it's a defensive play. People are naturally like want to move into bonds even though they've been beat up on them. So it definitely had a big move. We saw TLT move 3%, which is huge for TLT. The other interesting play is actually the utility space. The utility space is giving some pretty interesting divergence where if I was to compare the SP 500 in here, and if we just look at those two charts together, we're in this point where we saw this just before COVID, the COVID crash, which is we see utilities do exceptionally well. So the stock market topped out here. It's down about 5%, the SP 500. From that same time window, we've seen utilities, they have pushed up about 8%, but they're up about 6%. This is a huge divergence. The fact that the stock market is crashing and huge panic and people are moving into utilities, we saw almost this same type of thing happen just before the stock market fell off a cliff for COVID. And we see this over and over again, not to this extreme, but over the last several years, every time utilities perform really well, the indexes pull back a bit, the indexes usually will fall even more, and then utilities will fall with it. Right now, this is just a defensive play. When the stock market does potentially bounce over the next week or so, and it starts another down, if that's what it's going to do, utilities will get wiped out too. It's just a short-term play of people moving in. So there's this divergence here is a big warning flag that I think we're about to see big pullback in the market. That the internals, the weekly chart, when I look at our weekly trend chart of the markets, we want to know when we are in a bullish environment. We also want to know when we're in a bearish environment. We are still in a bullish environment right now, but everything this week, based on the closing bar, because this is the weekly chart, is telling us we are like kind of like right here, or we are like right here. We're very, very close. Everything behind the scenes, cycles, money flows, momentum, all of that stuff is telling us we are like right on the cusp of starting another bear market phase. And the question is it just a small bear market like 2022, or is it, a stage 4 massive financial reset like 2000 and 2008, where we see the stock market potentially fall 30, 50, 60% or more? That's where we have to stand. But behind the scenes, this market has broken down on a weekly standpoint based on a big trend. It hasn't given us an exit signal yet for long-term investment capital, but we are darn close, a week or 3 away from potentially closing all long-term positions in equities, because we're going to go into a potentially year or 2 pullback, or a lot bigger than that.
Okay, so Chris, right now we're looking at the spiders. Where did it close?
Closed at 532.
So 532. So let's just assume we're going to get continued weakness here in the coming weeks. Where do you see that going? I want to find out the potential downside.
Yeah. So based on the downside, I usually would drop down to the daily chart to get a short-term one. But if we were to use this weekly chart for the big view, which is I think what you're wanting to look at, usually you're going to see a pullback to the 38% or the 50% retracement level from the recent low. So percentage wise and dollar wise, we're looking at potentially another 7-8% that could happen. That will kill this uptrend. That will probably kick us into a bearish phase where we're breaking down. It could even pull back like 12-13% going forward. So there's quite a bit of downside. So that's $483 a share, or $457. Obviously, this is the more conservative one, and this is kind of what I expect could happen if we start to see the markets break down over the next week or 2 and start that downward journey. So there's quite a bit of downside, and it'll kill this bullish phase, hopefully much before that. And then it'll be a great opportunity, I think, for different assets to do well and to take advantage of potentially a big market correction.
Chris, that's a great overview. Why don't we just summarize everything you just said? So first of all, when it comes to the S&P, you think if we get another pullback here in the coming week or 2 weeks, we might see another 10 to 15% on the downside. Do I have that right?
Yeah, I think that's looking out, it's probably a month or 2. But yeah, I do think there's that downside. I think the markets will have a little bounce potentially next week or so. And then if they form a bearish pattern, we're probably going to see the SP 500 drop about 8%. The NASDAQ will probably drop more like 15%.
And then in terms of oil, you're also negative on oil. You see that
long term,
going
I'm
down.
definitely negative on oil. I think we'll be looking at $40-$45 next year.
And copper, I think you threw out $2 a pound.
Hey, that's an extreme low, but it's totally possible. If we go into a recession, and the selling kicks in, pretty much everything goes in that free fall mode. Yeah.
And yeah, and along those same lines, I should also tell our viewers, I just did a interview with Danielle DiMartino Booth. She's her belief is that we are already in a recession, or the US is in a recession. There's a recession going on in many countries throughout the world, including China, Germany, the UK, Canada is in a recession for sure. And so we have a slowing economy that's going to lead to lower oil prices, lower copper prices. And once again, if you want to see that interview, check it out on my YouTube channel, Bloor Street Capital. Okay, so you see the S&P coming under pressure, oil, copper. What about what's working now? Where do you see gold going from its current
Yeah,
levels?
I think gold is probably the highest probability, lowest risk play. I say lowest risk because it doesn't have much volatility. A big move in gold is like a percent and a half generally. So you can put money into it. It's disconnected from the stock market. The whole world naturally gravitates to it versus silver or miners. And so it has that upward bias. There's a reason why it's hitting new all-time highs, and it keeps pushing higher. So I like gold. 2650, 2750 are the two kind of upside targets there. And that's really the only one that I see at this point really working right now. That's the only asset that I like. Right now, we're sitting on the sidelines, and just kind of waiting for the markets to reset and give us a new opportunity.
But you also mentioned TLTs and utilities.
Yeah, TLT still needs some time to mature. It's not in an uptrend yet based on our analysis, but I like it. Like if I was to say in 3 months, we'll probably be like looking at TLT. It will be in a new uptrend, and it could be very good over the next year and a half.
And the last time we talked, you had a massive silver bar on your desk. Do you still have that, or did you sell it?
I do. I have, yeah, 1,000 ounce bar right here, which is incredibly heavy. Definitely a good boat anchor. And yeah, I've got all kinds of different metals. I like this cool stuff, which I'm not sure if it will focus. You can see these. It's like a credit card. These are 51-gram bars. So technically, if the world was to fall apart, you can take these little bricks and they just snap off. It fits in your wallet, so you could go buy milk or whatever you need. And it's pretty amazing. I mean, I got the gold 1 ounce bars as well. But the whole reason I bring this up is I was out once and the internet went down in Canada, and a guy came in. He goes, "Hey, Chris," he goes, "I filled my car up with 2 silver rounds." And the gas station took his silver rounds when all the credit card systems were down. And that made me think, I'm like, okay, well, I want to buy these little other things. So I have silver rounds, and I have these mini gold bars that you slide one into your wallet. You can break them off. If all hell breaks loose, you've got something small enough to barter with, right? Which is the key.
That's a good point. And we've seen that. I remember that was I believe it was the summer of 2022 when the cellular service went out
Yeah.
for, I don't know, close to 24 hours. And we just saw it recently with CrowdStrike. Look at the havoc that caused throughout the global economy. I believe it was over 10,000 flights were canceled because the whole software system went down.
Yeah, so I didn't think that affected me. And I went to go in my hot tub, and I'm like, why is my hot tub not working? Like, I run my hot tub off my phone, and I realized they sent out an update saying, our network is down. So I'm like, I can't hot tub because of a freaking network problem. But it was pretty wild. I didn't realize it was going to affect, how many weird little things it would affect.
Oh, it's crazy. Yeah. So it's amazing how beholden we are to the whole technology.
Yeah.
In the internet. But okay, well, listen, I want to thank you very much for spending time with us today and giving us some guidance on what we might expect in the coming weeks. If anybody wants to follow or check out Chris's services, there's a link below in the show notes. Make sure you click on it, check it out. I'm a subscriber. I love it. He provides lots of insights. And if you find out you don't like it, then you just cancel. No big deal. Chris, once again, I want to thank you very much for spending time with us today.
Hey, thanks, James. Always a pleasure. Take care.